Most traders assume that slow execution minimizes market impact, but the Almgren-Chriss model proves the opposite. The optimal trading trajectory is front-loaded. This means that to minimize total trading cost, you should trade more aggressively at the beginning of the execution period and gradually slow down. Imagine you need to sell a large block of stock. Your first instinct is to drip feed orders into the market, hoping to avoid moving the price. This seems logical. Smaller orders should cause less impact. However, this intuition ignores a crucial distinction between two types of market impact. Temporary impact is the immediate price concession you pay to execute now, which is related to the trading rate. Permanent impact is the lasting price move caused by your total trading activity, which is related to the remaining position. The Almgren-Chriss model shows that optimizing total cost means balancing these two forces, and the balance is not what you'd expect. By trading slowly, you keep a large remaining position for a longer time, which increases permanent impact. In contrast, trading faster early reduces the remaining position quickly, lowering permanent impact even though temporary impact is higher initially. The model defines total trading cost as the integral over time of two components. The first term, gamma times the trading rate times the remaining position, captures permanent impact. Here, gamma is a coefficient that measures how much the price moves permanently per unit of trading activity. The second term, eta times the trading rate squared, captures temporary impact. Eta is a coefficient that measures the temporary price concession per unit of trading rate. Both gamma and eta depend on the asset and market conditions, such as liquidity and volatility. The goal is to choose the trading rate over time to minimize this total cost. This is a calculus of variations problem, where we seek the function xt that minimizes the integral of these costs, subject to the boundary conditions that we start with the full position and end with 0. Using calculus of variations, we derive the optimal trading rate. The Euler-Lagrange equation gives a second-order differential equation for the optimal trajectory. Solving it with the boundary conditions that you start with the full position and end with 0, we get a hyperbolic sine function. This trajectory is concave. You trade faster at the beginning and slower at the end. The parameter omega, defined as the square root of gamma over eta, determines how front-loaded the strategy is. A larger omega means more front-loading, because permanent impact is relatively more important. The optimal trading rate is proportional to the hyperbolic cosine of omega times time, which is a decreasing function of time. This mathematical result directly contradicts the common intuition of starting slow and accelerating. The trading rate is the derivative of the position. It's a decreasing function of time, high at the start, low at the end. Why? By trading quickly early, you reduce your remaining position faster, which lowers the cumulative permanent impact. Yes, you pay more temporary impact up front, but the savings on permanent impact outweigh that cost. This is the core insight. Permanent impact is proportional to your remaining exposure, so reducing exposure early is disproportionately valuable. For example, if you sell 10% of your position in the first hour instead of spreading it evenly, you reduce the time that the remaining 90% is exposed to permanent impact. The temporary impact cost is quadratic in the trading rate, so doubling the rate quadruples the temporary cost, but the permanent impact savings are linear in the position reduction, so the net effect is favorable. Let's compare the common trader intuition with the mathematical optimum. The intuition is to start slow, test the waters, and then accelerate. The math says start fast and then decelerate. The intuition tries to minimize temporary impact, but it ignores the accumulating permanent impact of holding a large position. The math balances both, and the result is a concave trajectory. This is a classic case where mathematical optimization overturns a deeply held belief. For instance, a trader might think that by sending small orders initially, they can gauge market conditions without moving the price. However, during that time, the large remaining position is subject to permanent impact from other market participants' trades and information. The model shows that the cost of that exposure outweighs the benefit of lower temporary impact. The shape of the optimal trajectory depends on the ratio of permanent to temporary impact. If permanent impact is large, as in large cap stocks, omega is large, and the curve is steeper, you trade even more upfront. If temporary impact dominates, omega is small, and the trajectory is flatter, closer to a uniform rate. This means the optimal strategy is not universal, it must be tailored to the asset and market conditions. Getting these coefficients wrong can lead to suboptimal execution. For example, if you underestimate permanent impact, you might trade too slowly, leaving too much exposure and incurring higher permanent costs. Conversely, if you overestimate permanent impact, you might trade too aggressively, incurring excessive temporary costs. Accurate estimation of gamma and ETA is crucial for optimal execution. Modern execution algorithms use machine learning to estimate impact functions. If the model incorrectly assumes linear impact, the strategy will deviate from the true optimum. For example, if the algorithm underestimates permanent impact, it will trade too slowly, leaving too much exposure. Conversely, overestimating temporary impact might cause excessive front-loading. The key is to learn the impact function accurately from data, which is a challenging but crucial task. Machine learning models can capture nonlinearities and time-varying effects, but they require large amounts of data and careful validation. In practice, algorithms often use a combination of theoretical models and empirical data to estimate impact coefficients. The accuracy of these estimates directly affects the quality of execution, as even small errors can lead to significant cost differences. For traders, this means you should question the common practice of starting with small orders. In many cases, front-loading can reduce total cost. However, the model assumes a single asset and no other market participants. In reality, you might face information leakage or competitive trading, which could change the optimal strategy. Still, the core insight holds: permanent impact is a cost of exposure, and reducing exposure early is often beneficial. For example, if you are executing a large sell order, trading a significant portion early can reduce the time your position is exposed to adverse price movements. This is particularly important in volatile markets where permanent impact can be large. Traders should consider the trade-off between temporary and permanent impact when designing their execution schedules. No model is perfect. The Almgren-Chriss model assumes deterministic impact functions and no market feedback. In reality, impact can be stochastic, and other traders may react to your flow. If the market is highly competitive, front-loading might reveal your intentions and cause adverse price moves. Also, the model assumes you can trade continuously, but in practice, you face discrete order sizes and market hours. These limitations mean the model is a benchmark, not a final answer. For instance, if other traders detect your aggressive selling early, they might front-run you, increasing your costs. Additionally, the model does not account for the possibility of price jumps or liquidity shocks. Despite these limitations, the model provides a valuable framework for thinking about execution and highlights the importance of balancing different types of impact. Let's summarize the key points. First, the optimal execution trajectory is concave, not linear. Second, front-loading reduces permanent impact, which is often the dominant cost. Third, the balance between permanent and temporary impact determines the degree of front-loading. Fourth, AI algorithms must learn impact functions accurately to avoid suboptimal execution. Fifth, the model has limitations, but its core insight is robust. These points challenge the conventional wisdom and provide a framework for better execution. For example, a trader who understands these principles can design an execution schedule that minimizes total cost, even if it feels counterintuitive. The key is to recognize that permanent impact is a cost of holding exposure, and reducing exposure early can be beneficial. This framework is widely used in quantitative finance and has influenced the design of many execution algorithms. In conclusion, the Almgren-Chriss model reveals a powerful paradox. To minimize total trading cost, you should often trade faster at the start, not slower. This insight has profound implications for how we design execution algorithms and how we think about market impact. The next time you're about to execute a large order, consider whether your intuition is leading you astray. By applying the principles of this model, you can potentially reduce your execution costs and improve your trading performance. We read every comment and appreciate your engagement. Understanding the math behind execution can give you an edge in the markets, and we hope has provided you with valuable knowledge. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.